Okay, let's go ahead and get started. Welcome everybody. It's 7 o'clock, so we might as well jump right into it. And I'm recording this lecture. I went ahead and hit the record button, so anybody that's joining us a little bit late will have the opportunity to catch the posting on YouTube. So it's been 3 weeks since we last met. We had Labor Day in there, and then last week was module number 3. And remember, we're going every other week per the syllabus. I'm using the recorded lectures on the off weeks. And the course curriculum doesn't change that much, but Fiona clued me in this week that there were a couple of slides that were inconsistent between, I guess it would have been version 5 of the text and version 6 of the text. So the recorded lecture that I had posted out there on our YouTube site was recorded from version 5 slide deck, and tonight we'll be looking at version 6. And I went back and cross-referenced both of them, and there's no material differences that'll cause the testable material to differ. Fiona, you had mentioned some liquidity ratios and solvency ratios, which we're actually going to cover tonight. So I'm encouraged there that there won't be any problems. And if if we do happen to run into some confusion, just let me know. I'm pretty open-minded about that kind of stuff. Just a little bit of housekeeping. Looks like everybody's already done me the courtesy of putting themselves on mute, but somebody give me a thumbs up on the sound. Or we got a couple thumbs up there. Good. So it's just a courtesy to put yourself on mute so we don't get background noise. But please feel free to take yourself off mute and interrupt me at any time. That's how I actually want to start the class, is just getting a little bit of feedback from you, since it's been 3 weeks. I went into My Business Courses back-end teacher profile to look at everybody's progress so far, and it's been great. I mean, not everybody's keeping up with the homework, which is exactly what happens. That's no different from any other semester I've ever taught, and that's fine. But a good portion of you are, and those who have made it through module 3 already look like they're not having any troubles. Everybody that turned in a module 3 assignment, well, most of you got all the possible points, so that's terrific. So my agenda for tonight is to answer your questions first. Then I want to talk about the test, because it's already week 4. That means that we got our first exam coming up. Then I want to talk about our project. Then I want to talk about the Thomson 1 database that I didn't get to last time we connected. I want to walk you through that. And then tonight I'm going to lecture over module 4, and that'll be the last of the testable material before our first exam. So let me pause there and just open it up. How's it going? Questions, comments, anxieties, anything on my agenda that I need to add?
Outside of getting on Thomson 1 at like obscure times, I've had a terribly difficult time getting on there because UMKC only offers 5 individuals at a time. Do you have a secondary site that you would recommend other than, like, I mean, there's Morningstar and some other stuff, or, I mean, I've just been trying at weird times and haven't been able to access it.
Yeah, I don't know what to tell you there. I didn't realize our subscriptions were down to 5. I had thought at one point in time we had 20. I just logged in before class, so I was able to get on there successfully. So I don't know if 7 p.m. is a low traffic time or not. The only other thing I would advise is that those resources that are available on Thomson One that are unique to Thomson One can also be accessed through Bloomberg, but that's not a great solution for most of you all, I recognize, because the Bloomberg terminal is the only place you can get one of those is at the block school. So you have to actually go into the finance lab to get on there. So not a great answer. I wish I had something better for you.
Thanks, appreciate that though.
Yeah. Okay, so I don't hear any other questions. Interrupt me at any time, notwithstanding. But since the first question was on that Thomson One, before I time out, why don't I just toggle over there and I'll show you what's available for your research projects. Okay, share screen. Okay, looks like I'm sharing the screen. Wait a minute. You cannot minimize Zoom when you're recording. Okay, no problem. I want to go over to. Okay, can you see this screen that says Thomson One up top?
No.
No. Okay. What I'm going to do then is share screen, screen 2, share. Okay. How about now? Anybody give me? I lost it. Okay. Thank you. Thank you. When I share the screen, I lose everybody's faces, so I can't take a thumbs up anymore. So I appreciate the verbal there. Okay, now recall how I got here. Let me pull my other screen up over here. I got here by going to the UMKC website, and then at the bottom there's a link to libraries, and then we want the Miller-Nichols library. Takes us to another screen, and this will allow us to link to databases. It was right here in the left column. Click on databases, go over to T, and scroll down to Thomson One, investment banking. And that's going to take us out here to this database, which I have queued up over here. And I have it on a separate screen because you can see I'm using Internet Explorer. Most of the time, Google Chrome is my go-to, so I have all my links and passwords set up through Google Chrome. Unfortunately, you can only access Thomson One through Internet Explorer. So you'll have to go in here and use Internet Explorer. So let's see, somebody give me, throw out a ticker symbol from one of your research companies.
NTRS.
NTRS, okay, thank you, NTRS. Northern Trust, is that right?
Yes, sir.
Okay, what is Northern Trust?
Northern Trust is a global asset manager.
Okay, well, you're kind of on the borderline of that banking industry, but asset management should work. You're dealing with some numbers in the asset management industry that aren't going to tie back perfectly to the course curriculum, because everything that we're doing in class is, well, it's just kind of generally built on the framework of a manufacturing industry. But you just be mindful of that as you're going through your analysis of Northern Trust, and if you run into any hiccups, let me know.
I'm already running into hiccups.
Okay, well, it's not too early to switch. So think that through a little bit, and if you want to switch, there's no problem.
Okay.
But I wanted to give you all a preview of the site. So we're looking at Northern Trust here, and one of the first things that you're going to want to do is, well, just play around in here for one. I mean, you're looking at like these key ratios over here. You know, last week we talked about return on equity, and that's right here. And you can click into it and find the individual components of return on equity. So that was part of the homework for tonight. And this ratio analysis that shows up on the homepage is also required of the homepage for your case study, your project assignment. So there's a lot of great data that's showing up here right on the front page that you'll need for your assignment, and it's downloadable and you can print it. You can click on the little PDF icon over here, and let's see here. And then you got a whole bunch of different tabs. So I won't go into each one of these, but it would be, it would really behoove you to spend some time with this tool. I think if you get out into the real world and you want access to this, it'll cost you $30,000 a year. So there's just a tremendous amount of information here. You have company news and SEC filings and banking relationships and all kinds of information. One of the pieces we're going to look at tonight we're going to cover debt, and we're going to look at what goes into a company's credit rating and what their capital structure looks like. And you can see here that Northern Trust has all of these different debt issues. You know, you can see that they have debt outstanding dating all the way back to, well, there's 07. There's one from 1989. Look at that. In 1989, they issued some corporate debt, and it looks like you can still go out into the public market and buy that. So that's been outstanding for how long now? 89, 99, 209, almost 30 years. So that's some incredibly long-lived debt that they have outstanding. So, you know, based on tonight's lecture, you'd click on this debt overview tab and you'd gain a lot of insights into what their debt looks like and what it's rated and when it's coming due. And you'd use that for a liquidity analysis and a profitability analysis and so on and so forth. Research. This research tab is going to be incredibly beneficial for everybody in the class. So make sure you come into Thomson 1, click on research, then go to company research. And this is where I suggest that everybody come to get a jump start on their project, because you can typically find some tremendous work that's already been done by some very, very smart Wall Street analysts. And what I recommend is that you look at the first page. This is going to give you the last 90 days of research by anybody that uploads to Thomson 1's database. And you can see here, you just sort by pages, which is, you know, right over here. If you sort by that number, you can see that there's some lengthy research reports out here. Here's one that's 87 pages long by some company called Buy Sell Signals. So I've never heard of Buy Sell Signals, so we might just kind of move on down to the next one. Okay, there's Morningstar, but we have access through Morningstar in a different database. So here's Barclays. Barclays is a reputable shop that everybody knows. If we click on that report, you know, click on any of these, there might be good information in all of them. But you can select all the reports that come with that and view, and you're going to see a 19-page report that's been compiled on Northern Trust by Barclays. That's probably a pretty good overview of the company and what their key issues are, and maybe management team. So if I pull open this report, you can see that you're getting an overview of the company. You know, on the very first page, you're getting their key performance indicators, how the company's been affected by COVID, what their PPP loans look like, all of the most recent issues affecting the enterprise value of the business that you're going to need to be familiar with as the analyst. So that's terrific. It's right there prepackaged for you. And then you get, looks like you get their income statement on page 2. So that's great, very useful. And then you get a little bit more detail on some of those key issues that they laid out for you on the front page there, and it just goes in depth. And not only can you print off the Barclays report, but there's probably another 15 or 20 out there that you can similarly print off. So go out there, click on the research report tab, make sure you have the latest research for the company that you're looking at. And come on, let me back in. What did I do? Oh, there we go. Okay. And then I want you to use this data range and go back. Just go back to all. So max 200 reports. And I want you to click this little button that says initiating coverage. The way Wall Street works is that the sell side, and that's what we're looking at here, is the sell side. They sell research and other services to institutional portfolio managers. When the sell side analyst begins coverage on any company, they're going to launch an initiating coverage report. And that's usually the biggest, most in-depth, most detailed report that an analyst will ever write. And they typically only write one. And after they've written that one, they write update reports. And those are going to be much shorter. So the body of work includes one big honking initiating coverage report. And then for the life of that analyst, they may never write another one. They'll just write little 5-6 page reports that are update reports. So I encourage everybody to go back here and search for initiating coverage. And let's click on that link here. And then we have, so now these go back a ways. And you're going to have to, like, here's one from 01. Probably not as relevant anymore. But if we scroll down, we're going to sort by date and grab the initiating coverage report that's the most recent, which would be one by Wolf Research and another one by Wells Fargo. Not particularly long by initiating coverage standards, 15 pages, 16 pages. Here's one that's 32 pages by Wells Fargo, probably a different analyst at that point in time. So these are good sources of information to get a jump start on your company. Usually get management, and other commentary that you don't get in an update report. So you click on that, download it, and you can see here's Wells Fargo. They initiated coverage 2 years ago with price target of 90. You know, this is going to give you a great feel for how well your management team or the business in general has executed over the last couple of years. So here's this particular analyst's thesis as of 2017. So, okay, great. Well, that's a great place to start. You know, find out what Wall Street, find out what this analyst community, find out what these researchers thought of this company several years ago, and then compare that to how history actually unfolded. You know, was this company able to execute? And if so, how? Was this management team able to execute? And if so, how? Was it their own doing? Do we have confidence in this management team? Do we want to put our money with them in the future? These types of reports, while a little bit dated, are still great overviews of the business and give us insights into how that business has performed. Okay, that's my quick and dirty overview of Thomson 1. I just wanted to point out the research tab, but then there's a wealth of information on all of these other tabs. So just go in there and play around a little bit. Okay, I'm going to set that aside for now. And I want to talk about the exam. So to date in the class, we've had 3 homework assignments. There'll be another one tonight associated with Module 4. And then sometime this week, I'm going to post the exam to my business courses website. And you know, technically, I usually don't open the exam until week 5. So that would be next Monday night, because I like for everybody in class to have an opportunity to hear the lecture over Module 4, do the homework over Module 4, and then ask questions over anything that might have stumped them. And then the exam, I usually open it and it's taken through the My Business Courses class. And recall how I set this up when we were going over the syllabus. It's open book, open note. So you're going to go to the My Business Courses class and you're going to click on the exam just like you would homework. This is multiple choice, so it doesn't have the interactive feel that the homework has, but it'll be multiple choice testable questions over the same material. There'll be 40 questions, and you'll have 2 hours to take the exam. And it's timed for a reason. An open book, open note test, well, if it wasn't timed, everybody should get 100% on an open book, open note test. But the timed nature of the exam is what makes it a little bit challenging. Don't go into the exam thinking, well, it's open book, open note, I don't need to study. That's where you will fail, because open book, open note means that you have a chance, you have an opportunity to probably look up maybe 1 in every 3, 1 in every 4 questions, or you're going to run out of time. If you haven't kept up enough with the material, if you haven't followed along with the book, if you haven't followed along with the lectures, if you haven't done your homework, then you won't know the material well enough and you'll run out of time. If you have done all of those things, you won't need the open book, open note nature, because you're going to be able to quickly move through the exam, and the time nature of it won't cause you any problems. And I don't expect you'll have any problem with the exam at all. Modules 1 through 4 have been mostly review. Most of the material that we've been covering in modules 1 through 4 has also been covered in the prerequisites for this class. So it's a little bit of a review. So the grades are typically higher on exam 1. And then moving into modules 5 through 8, we go a little bit deeper into the accounting and cover some new material. So, the class does get tougher moving forward. But I'll post that sometime this week and shoot out a note over I don't know, Canvas. And then let me look at the dates here on the calendar. Here's my calendar. So let's see, tonight's the 21st. I'll post that exam by the 28th, which would be the 5th week in class. And then you'll have, that exam won't be due until, let's see, that exam won't be due until August 4th. No, the 5th, that's the Monday. No, not August, October. So you'll have over a week to take that and submit it. So having said all that about the exam, any questions there before we move on?
Do we only take it once?
Say that again.
Do we only take it once, or we have to take it multiple times?
You can only take it once. Once that timer starts going, you got 2 hours, and then time's up, and yeah,
take a break,
and your score's in.
and take a break and come back.
Yeah, it'll be incomplete if you don't get it in on time.
Well, like, can you take some of them and take a break and come back and finish it?
Oh no, there's no pause button. If you take a break, the timer keeps running.
Okay.
So yeah, make sure you got a solid 2 hour block of time to take that. And use your smart test taking skills too. Go through, answer all the questions that you know, come back, spend the time on the one you don't know, so that you don't want to get to the 3rd question on the exam and spend 30 minutes on it. That's a terrible test taking strategy. If you don't know it, move on. Answer the ones you know, then come back.
What's the question format? Is it all multiple choice?
It's all multiple choice, yes, sir. And
I had a question about, oh, sorry.
Well, I want to get your question, but I just thought of something, just kind of a pro tip for these exams. It's multiple choice, and sometimes I've been a little bit disappointed in the authors of the text, because one of the ways that you make a multiple choice exam difficult is that you word them in a tricky way, or you include 2 answers that are almost identical, just off by a keystroke or something like that. Nah, I don't like that. I try to avoid questions like that, but if you do think that one of them was just unfair for whatever reason, bring it to my attention. I'll make adjustments necessary. Fire away. What was your question?
That was kind of what my question was going to be. Sometimes some questions are very particular about rounding, or if we're doing any rounding with, you know, any mathematical sort of articulation, and some of them aren't. So I just wondered if these questions are clear. We've run into it, or I've run into it in the past with these sort of online tests like that. So.
Yeah, and so have I. You know, this is my 5th year teaching this class, so I've weeded out a lot. I'm not going to promise I've weeded out all the questions that are tricky like that, but I've weeded out a lot. So if you run into that, just let me know. Now, after the test closes, after everybody's finished the exam and turned it in, you'll be able to see your scores. And when you are able to see your scores, you're also going to see an explanation of why each multiple choice question was the answer it was. And most of the time, students get to that explanation and they have kind of an aha moment, and they're like, oh, okay, I see where I went wrong there. Some of the time it's like, no, that was BS. The test question was unfair. And if it's unfair, we'll make an adjustment. So look for that day or two after the test ends, and go through and analyze any of the ones that you might have missed. And then remember, I may curve the exam. I haven't had to do that for the last couple of semesters, but if scores are much lower than I expect, I can curve. I usually wait until the end of the semester to do that, but I will go back and I'll look on the day of the exam, and you're only eligible to receive the curve if you have your homework completed up through the date of the exam. I don't think it's fair to give away free points to students who haven't been keeping current with their homework. Now remember, I don't penalize you for late homework, but I'm also not going to give away free points if you've just been lagging behind. So stay current. If we need to curve it, you'll be eligible for the curve. Okay, so my agenda was questions up front, wanted to cover the test, wanted to cover Reuters. I'm going to lecture over Module 4. And then as I do lecture over Module 4, I'm going to try to give you some give commentary, insights, whatever, advice on your semester research project. But I suspect as we enter into exam 1, everybody's probably got that on the back burner until we get past exam 1. Nevertheless, you should be in the process, somewhere in the process of building your source documentation. So I just gave you a tour of Reuters tonight. I'm hopeful in the last 2 weeks you used the tour I gave you of all the other databases to go in and start compiling some of those source docs. If not, jump on that. Start with Morningstar, start with your company's investor relation page, move on to Reuters, search for an initiating coverage document, search for other analyst research, and then just plow through all those other databases that UMKC gives us access to. And I think you're going to find that there's too much information rather than too little. The challenge to this research project can be overwhelming, and it's really discerning which of these sources is going to do most of the heavy lifting when you're putting your project together. Okay, gang. With all that as an intro, why don't I segue? And tonight we're going to talk about credit risk analysis and interpretation. Again, most of this is a review. We have 50, 60 slides to plow through tonight, everything from solvency analysis, liquidity analysis, to what goes into a credit rating agency's rating and how do those work. But I think I'll be able to move pretty quickly. If I get to going too fast, just stop me. But most of this stuff is, like I say, review. Okay. There we go. I wanted to pull up the chat feature for our group here so I could see anybody that wanted to chat with me. sometimes that works a little bit better when audio is garbled. Not everybody's internet connection is the best, and sometimes it's mine. Okay, let's hop to it. So learning objective number one is to describe the demand and supply of credit. And we're primarily talking about bonds. Bonds traded in the public market, very similar to stocks, only these are issued by the company rather than actual shares of the company. These are individual pieces of debt outstanding. And then there's a secondary market for these where we can trade them just like we can equity securities. And when we looked at Northern Trust there a minute ago, you saw that they had outstanding issues dating all the way back to 1989. So companies may need to borrow this year, next year, the year after that. Every year a company needs to borrow. They go to the public markets and they issue debt. And then anybody on this call, any investor, anybody in the public can go to one of the trading firms. I do all of our clients trading through Fidelity. So if you have a Fidelity account, you can go to Fidelity and you can say, I'm not really interested in the stock of Procter and Gamble, but I think I'm comfortable with their debt outstanding. And the basic proposition that backs that trade is that the stock might be risky. You know, maybe you're, let's use Tesla as an example. They're such a high flyer. Maybe you're not super excited about the prospects for Tesla's stock, but you are pretty sure that they're not going to go out of business. They're not going to go bankrupt. And if that's true, then agreeing to loan them money, which is the transaction that we're talking about here when we talk about purchasing a bond, agreeing to loan Tesla money is a fairly riskless transaction relatively, not without risk completely, but on a relative basis, it has a lot less risk associated with it. So that is a way that companies entice investors to help fund their activities. And their activities are seen right here. Those funds that they borrow are going to operating, investing, and financing. So operating activities, that's what your companies that you're looking at this semester do. So if you're talking about Procter & Gamble, you're talking about making shampoo and diapers. Investing activities, so for Procter & Gamble, this wouldn't be ops, but it would be the increase in property, plant, and equipment. So maybe Procter & Gamble wants to, maybe they want to buy a new line. I don't know what they want to buy. Maybe they want to expand into a new vertical. Maybe they want to buy craft or something like that. If they went out and borrowed money to do that, that would be part of their investing activities. Financing activities are what we've been seeing so much of in the markets for the last six or 8 years. Companies have been borrowing money so that they can go back into the markets and buy their own stock back. That would fall underneath the financing activity. Now, why would a company want to buy their own stock back? Well, for all kinds of reasons. And one of the reasons is why I have you do the proxy analysis as the very first assignment in this class. Because when you buy your own stock back, you reduce the number of shares outstanding. And if you reduce the number of shares outstanding, then all else equal, your earnings per share is going to rise. So, okay, what's that mean? Well, you all should be smart enough to recognize now that if you have a management team and their salary, their bonus, their incentive comp is linked to earnings per share, and then you see a lot of this going on, buying back shares in the market, well, there's a pretty good likelihood that that's intended to boost their earnings per share number and in the process get them paid. So watch out for that kind of stuff. I mean, this class is all about those kind of shenanigans, and I want you to have a good understanding of how that might unfold for your management teams. Now, I'm obviously thinking with my skeptic's hat on here, because another perfectly rational explanation for buying your own stock back is that, well, imagine yourself as the CEO of a Fortune 500 company. Who better to know when your stock is cheap or expensive? So this is called a signaling activity. And in finance, we look at executives who buy their own stock back as signaling to the market that that stock should be cheap. Now, if you're giving your execs the benefit of the doubt and they have a track record for buying their own stock back when it actually is cheap, and you can go back and measure something like that, well, that's terrific. And that signal is probably very positive news for your stock in general. But if your management team is just buying back stock every quarter without much regard to the actual price of it, there might be something else going on altogether, and we might want to think about that a little bit more skeptically. Okay, so many parties offer credit. These don't have to be public markets. You know, I generally take the perspective of the public market investors because that's all of us, and I'm an investor myself, so that's just kind of how I think. But we also see debt on the balance sheets of the companies that you're looking at that has been, you know, that comes from trade creditors, banks, private lenders, and analyze all that. And when you go to Reuters, you're going to see what's called a cap table. And that cap table, cap stands for capitalization, and table is just basically a big list of all of the individual debt issues that they have outstanding going back sometimes many years, and where those issues show up in the cap structure. So which one's senior? In a bankruptcy type scenario, which one of those issues gets paid off first? This is something you want to know if you've loaned money to a company, because, well, as we'll look at here in a minute, when we start analyzing liquidity ratios and solvency ratios, if something were to go wrong, you're going to use that information to have a good understanding of when exactly you get paid. Because if a company goes bankrupt, there may be a liquidation involved. And if there's a liquidation involved, then those payouts are going to go to creditors according to the cap structure. So you want to be number one on that list because you're likely going to get paid. Now, as you can imagine, as you move from number one on that list to 5 to 10 to 20 to 30 to 50, well, 50 doesn't feel very good. And if you know you're going to be 50 on somebody's cap table, what are you likely to do? You're likely to say, well, I'm not going to loan you that money, knowing that I'm going to be 50 on the cap table, unless you make it worth my while, meaning pay me a higher interest rate. Because that's the fundamental law of risk and return in our business. If something is riskier, it requires a higher rate of return. And we see that as credit rating agencies put a rating on debt outstanding for not just public investors, but sometimes banks and private lenders too. They'll help us. They'll look at the company, they'll help us decide how risky it is, and then they'll rate it. And I'll show you the ratings here in a minute. They typically go from A to B to C to, I think, below C is like F or something like that. And as you move down that credit rating scale, interest rates go up. And we'll talk about that a little bit more in a minute here. Okay, so I think I just touched on the next 4 or 5 slides in that little rant. I talked about operating activities. So credit can be borrowed to basically pay for the daily needs of a company. We call those the cyclical operating cash flow needs, used to fund operating profits and loss. Investing activities, this was the example I gave of investing in property, plant, and equipment, or maybe even mergers and acquisition type activity. These are usually fairly large in nature. And then financing activities used to pay dividends or repurchase stock would be the most common instance of borrowing for financing activities. A little bit less routine, I guess you would say, would be borrowing on trade. Less routine from a, quite routine, excuse me, but less routine from a financial analyst standpoint, because this debt becomes non-interest bearing. So we have a tendency to exclude it from our analysis of total debt outstanding when we analyze a company, because it doesn't bear interest and it's a normal part of the ongoing operations. When we look at a company's liquidity, we typically exclude non-interest bearing debt. Some terms associated with this type of debt that you see every once in a while. You'll see early payment discounts. Maybe in an earlier accounting class, you analyzed trade credits as 2 net 10 or 3 net 15. That gets you a discount if you pay within 2 days or within 3 days. Otherwise, the debt might be due in 15 or 30 days, and no discount would be associated with that. Those are pretty common terms. Credit limits, other payment terms, nothing too terribly exciting about that. Okay, we're still talking about the supply of credit. Bank loans are very, very common. My company that I work for / own, Two West Advisors, has a bank loan outstanding. We do business with CrossFirst here in town, and they loan us a little bit of money, and that goes on our balance sheet, and we use that to expand our operations a couple years ago when we moved into academia and a few other lines. Very common for a business to borrow from a bank so that they can either fund operations or expand operations. And you'll sit down and have a conversation with your bankers, and they'll ask you all of the same questions that you're asking of the companies that you're analyzing this semester. And I'll show you that on a slide here. The analysis is the same. You want to know the management team, you want to understand the business, you want to understand the key performance indicators, you want to understand the competitive dynamics, and basically the prospects for the future of that business so that you can quantify the likelihood that that loan is going to get repaid. And banks go through that exact same analysis. And well, and for everybody in this class that's going to be looking for a job after they graduate, I would hope that that the work we're doing in this class would serve as an example of what you could be doing for a bank in their credit ratings department. And you know, remember the intent of the research project. The intent of the research project is that you'll have something at the end of the semester that you can take and show a future employer. Oh, and so here's an example. We had a job opening at our firm recently, and I posted this to LinkedIn, and I got 80 resumes. And I hired a recruiter to go out and look for us, and he found another 140. But very, very few of those were qualified. We got a lot of, I'll just call it, we just got a lot of people submitting their resume with almost zero thought to whether or not they were qualified. So it was really quite a job to sift through all of them. But I narrowed it down. I interviewed 9 candidates, and one of the candidates that reached out to me was in my class, was in this class. So I said, okay, well, I know for the last 5 years, I've been telling every class I've ever taught that the intent of the research project is to be a writing sample that you can hand a future employer and use to land your job. I mean, I really want this to be something that that you can really be proud of. And if you write it like either one of the examples that are posted out there on that site, I would expect it to land you a job. Okay, so knowing all that, I'm like, great. I mean, I remembered this student as somebody I really liked, but I lose track of who's been through this class and who hasn't. So I never would have remembered the research paper that he wrote. But I'm like, okay, well, I'm gonna go back and I'm gonna look it up. And I used that to inform my decision making about how far that candidate made it through the interview process. And you know, I'm not going to disclose whether the paper was good or bad or who the candidate was, but it's meaningful. So that's my hope, that everybody in this class can take away something that they can really be proud of, and sharing that with a future employer is just a wonderful example of how well you write and how well you analyze different situations, and how well a position like this and many others might be suitable for you in the future. Okay, let me move on there. Other forms that you might run into, other forms of supply that you might run into when you're looking at a company's balance sheet. Non-bank private financing, a lot of times you'll see private equity. That's very, very common. And then lease financing. we'll go through a whole module on lease financing because there's some accounting associated with lease financing that I want you all to be aware of, but we don't need to know it for the first exam. Some general rules about how debt is issued. Be familiar with the term commercial paper. If you haven't already heard that, just know that that's debt that represents short-term borrowing there, and the short term is defined as 270 days or less. And there's a lot of turmoil in the commercial paper market right now because interest rates are so low. Wall Street Journal just had an article this week talking about how Coca-Cola had refinanced their debt. So they went out into the public markets and they bought all of the debt that they had outstanding that was yielding 3%, and they refinanced it with 30-year paper that was yielding, I think it was 0.7% interest, which is incredibly low. And the interest rates just get lower and lower and lower as you move from long-term to short-term. And by the time you get to 270 days or less, there's almost no yield left. The yield is so low, as a matter of fact, and when I say yield, I mean the interest rate, is so low, as a matter of fact, that the money market firms that make a business out of investing in short-term paper, they can't make a profit anymore because the yield on commercial paper is so low it doesn't cover their operating costs. So you're seeing businesses like Fidelity and Vanguard close their money market funds because of this. And we do business on behalf of a lot of 401ks, and it's crucial that your 401k has a cash-like option in it. Well, more and more so, it looks like most 401ks or many 401ks are going to have to do away with their money market accounts and either go to just a straight cash account or some sort of stable value type offering. And then before I move on, I'll just say that bonds, which you hear me talk mostly about, are also called debentures. Those are longer durations and regulated by the SEC, and they typically have, not always, but they typically have semi-annual interest payments, sometime annual, but usually semi-annual interest payments. And we'll talk about those more, I think, in Module 6. Okay, I mentioned that I was going to explain the credit analysis process. I've already explained the credit analysis process, or rather our authors have, in Module 1. So everything that we'll do in this class is part of the credit analysis process. And when I say that, what I mean is that when we go back to Module 1, and I'm talking about a Porter's 5 forces analysis, or I'm talking about a SWOT analysis, or I'm talking about analyzing your competitive positioning, or even like last week when we were looking at return on equity and the disaggregation of return on equity so that we can gain some insights into where a company's returns are coming from, or the management team, or how the company's structured. All of that is relevant to the credit analysis process. As an equity investor, what we want to know is how much money is going to drop to the bottom line. Well, we call that net earnings. As a credit analyst, what you want to know is the likelihood that you're going to get repaid with interest. And to show that, you look at earnings before interest. It's literally the next line up on the income statement. So there's hardly any difference in the analysis process that you go through. And you'll see, this is what you're after, the expected credit loss. So to know that, you have to have the chance of default, which is, to know the chance of default, you have to know everything I just laid out times the loss given default. And this is the second component that we haven't really touched on yet, but what is that loss if the company defaults? So everything that I talked about in the analysis of the management team and the ratios and the structure is right here. That helps us get at the chance of default. And then secondly, well, what's our loss if it does default? So take your mortgage as an example. I have a mortgage. I have about, I think I'm into the bank for maybe 50% of the value of my home. But the home is used as collateral. So let's use round numbers. Let's say my house is worth $200,000. but I have a $100,000 loan outstanding. Well, if I just completely default on that loan, the bank is going to repossess an asset that's worth $200,000. They're going to sell it. The likelihood that they get their money back, I'm not going to say it's 100%, but it's a near 100%. So that's a pretty good, the expected credit loss on a mortgage is very, very low. And you'll see credit analysts use that same basic framework regardless of who they're loaning money to or what dynamics might be driving the supply of credit. Here's this basic steps. You might just earmark this. This would be a pretty good test question. You know, what are the steps involved in credit analysis? Evaluate the nature and purposes of the loan, assess the macroeconomic environment and the industry conditions, perform financial analysis, and then perform prospective analysis, which would kind of be your forecast of financials into the future. And you know, here again, we're going to have a module on each one of those as we look at it through the lens of an equity investor. And I'm not going to dwell on, I think there's a slide for each one of those steps. Evaluate the nature and purpose of the loan. That's the Porter's 5 forces, strategic, analytical type framework. Assess the macroeconomic environment. Here's more on Porter's 5 forces. You literally industry competition, bargaining power of buyers. You need to be doing this for the companies that you chose for your research project. And fortunately, if you go through those databases, I think it's ProQuest, but it might be another one, and you might be able to get this in multiple places. This has already been done for you. So again, that's not a heavy lift. You just have to know where to go to get it, and then put it in your research papers. Don't copy it, cite it. as long as you cite it and you have it in the appropriate bibliography, you're fine. Analyze the financial ratios. I'm not going to go into that right now. And then perform prospective analysis, which is its ability to pay those debts given the company's future ratios. So how do you expect, given the debt that company has outstanding, how do you expect their future to unfold? So say, for example, I was using Procter & Gamble. Say, for example, Procter & Gamble went out, used that debt to buy a new factory. That factory is going to start producing shampoo or diapers or whatever, and then they're going to sell that into the market. That's going to create revenues. Those revenues are going to come back, increase the revenues of the income statement, drop to the bottom line, and P&G is going to use those monies to service that debt and ultimately pay it off. Now, you as the analyst have to come to some conclusion about the likelihood that they're going to be able to execute on that, because I guarantee you, when they came asking for the money, they had a prospectus or a fancy PowerPoint that showed what they expected to be able to do with that money. And well, I've never seen an investor presentation that showed anything other than future returns going up and to the right. So you always have, okay, this is your money. This is how your money's going to grow if you give it to us. And the chart always looks like some version of that. I have never seen an investor presentation that said, okay, here's your money. We're going to let it sit in the bank for a couple of years, and then we expect to lose most of it. That's not how investor presentations work. So I say that because you and everybody else that's ever sat through an investor presentation needs to look at it with a very skeptical eye, because they're just that. They're presentations. They're not even really investor presentations. They're sales presentations. And some of them sound pretty good, but none of them ever show net future losses expected. Okay, here's the second term that a credit analyst will focus on. It's called loss given default, LGD. So now we're assuming the loan defaults. What happens next? Well, if a company fails to make a payment, you're going to look at the priority of the claim. Okay. If a company fails to make a payment, they're likely going through bankruptcy proceedings. So now we need to know where we fall in that cap structure. It's get in line. Where do we fall in line? That's going to help us determine what our likelihood of getting paid back is. Next, we're going to look at credit limits, collateral, repayment terms, covenants. These are all individual pieces of legal terminology that can provide protections to the creditor in a bankruptcy scenario. And then the one that I like most is collateral, because that's the mortgage example. If you have something that's actually worth something that you can sell and that's liquid enough to get your money back, this can offer the most protection. Repayment terms, you can structure those repayment terms any way you want. You can link those to different ratios. I want you all to be very, very familiar with this term called covenants. And you might open one of those, like if you go to Thomson Reuters again, if you go back over to Thomson Reuters and you go to debt, if I can go over here, if I go to debt, if I'm still logged in, it might have kicked me out. Looks like it probably did. So anyway, if you go over to Thomson Reuters and you search for debt again, you're going to get a cap table. You're going to get a listing of all the debt outstanding. And with each one of those listings, you're going to be able to click through and you're going to get the offering memorandum and the prospectus and anything else that was filed when that debt was originally issued. And it may not, but it may have covenant terms in there. And if it has covenant terms in there, that's the lender superimposing conditions on the borrowing of that money. And basically they're saying, yeah, I'll agree to loan you that money, but you have to keep your solvency ratios above 1.25. And if they ever drop below 1.25, I'm picking numbers out of thin air here. If they ever drop below 1.25, we get to call that whole debt. And that kind of holds an executive's feet to the fire, keeps them honest, so to speak, but it can also present a lot of risk to the equity investor. And you all as analysts need to understand what covenants your companies have agreed to and whether or not there's any danger that they might trigger those covenants. Because some of those legal contractual contracts can be written, well, they can just be onerous. I mean, the terms can be severe, giving a lot of power to whoever loaned the money. And that has everything to do with how tight or loose the credit markets are in any given period of time. And if you have tight markets, that means that the lenders have all the power and they can basically negotiate whatever covenants that they want into that relationship. If you have a loose credit market, then it means you have a lot of supply and the borrowers have all the power. So if the borrower goes to a lender and they want covenants, the borrower will just say, thank you, but no thank you. I'm going to go across the street and borrow from somebody else who doesn't require them. Right now, during this particular period of time, we're in a very loose credit market, meaning that all of the power is with the borrowers. It's easy to borrow money, and the terms associated with borrowing that money are generally pretty, well, they're not very strict. Covered all that, talked about collateral, repayment terms. Here's a nice graphic that basically lays out this whole slide. Longer term equals greater chance of default. Greater chance of default equals greater credit risk. Greater credit risk equals higher cost of debt financing. So as the term goes up, the interest rate goes up. And I think that's pretty intuitive for most investors to understand. That general relationship, so if I graph that general relationship for all bonds in the stock market, you start over here with this is called the risk-free rate. And right now that's set by the Federal Reserve, and well, it's not very high, but for the sake of illustration, let's just call that 1%. And this is time on the horizontal axis. So what you see is the risk-free rate as it moves out across time generally rises. And what I just drew for you there in very poor penmanship or whatever. That's what we call the yield curve. If you ever hear anybody refer to the yield curve, they're just talking about the relationship between risk and time, and how the longer you go out, the more interest you should expect. Now, sometimes, so here's something else that you might like. Sometimes, not very often, you'll see what investors call an inverted yield curve, meaning that relationship has inverted and you can borrow cheaper longer. If you go out on the yield curve a little bit, it's cheaper to borrow longer term than it is to borrow short term. Now, that's a very negative thing. If you look back historically, that's typically been a marker of a recession that's on the horizon. So we pay attention to that yield curve, and when it goes a little backwards like that, it should be a little bit of a warning signal. Okay, loss given default. I talked about covenants. There's 3 basic types. The first one requires the borrower to take certain actions, such as submitting financial statements. That's really a pretty tame one. Another one would be to restrict the borrower from taking certain actions, such as preventing mergers or acquisitions, or sometimes even dividends. And then the one I specifically mentioned was requiring the borrower to maintain specific financial conditions. So they might be looking at interest coverage ratios or solvency ratios or something like that. Let's look at interest and credit measures. Adjusting financial information. We're going to do this throughout the course. Financial statement analysis, a big part of that is first we need to understand the financials, and then we need to understand how the accounting affects the financials, because there are a lot of estimates that go into GAAP accounting, and they don't all make sense. And when they don't make sense, or somehow they position 2 companies that ought to be comparables against one another with different accounting measures, they're using different GAAP accounting, we need to be able to make adjustments for that. And one of the adjustments that our authors go into here are retail firms that might have a 53rd week in their year. And the authors talk about Home Depot. If a company's not using a calendar year for its fiscal year, they might use like the first Monday in October to the following first Monday in October might be their year. Well, sometimes the way the days fall on the calendar, that can result in 53 weeks being reported in a GAAP year. So if that happens, then you might need to make a reconciliation and adjust for financials that are reflective of only 52 weeks instead of 53 weeks. And that way you're going to be able to compare Home Depot's financials to Lowe's or another one of their competitors. Okay. Okay, profitability analysis. We covered ROE last week. ROE disaggregates into return on assets and financial leverage. These are the 2 major formulas. Return on assets is net income over average total assets. Financial leverage is total assets over stockholders' equity. If we look at Home Depot, you can see the numbers presented here don't make a whole lot of sense. So ROE, 5,125%. Well, that's such a nonsensical number because Home Depot hardly has any equity on its balance sheet because they've been engaging in these stock buybacks for years and years and years, and they've nearly bought back the entirety of the book value outstanding for their equity numbers. So our authors take us through an adjustment that we might do to make these numbers, basically make more sense. And what we can do is add back the treasury stock associated with Home Depot's stock valuation. And as we do add back that treasury stock, you can see that, the ROE looks a little bit more like what we would expect to see. you can see the trend there over the last few years, moving from 18 to 18.3 to 20. So they're right, moving in the basic general right direction. And then moving on with that Home Depot analysis, we can do the same thing with return on net operating assets, which again disaggregates into net operating profit after tax divided by sales, and then sales over average net operating assets. And both of these were detailed in Module 3. So you need to understand what goes into operating assets. Just take a look at Module 3. But you can see that numbers, adjusted numbers on the bottom of slide 30 here, kind of break out into those individual terms. And again, what I want everybody to do for their research project is not just compare all of these ratios to a historical analysis, which will let you identify trends and other insights, but also compare them to a peer group. These are the coverage ratios that are more commonly associated with credit analysis, specifically the times interest earned. That gives us some insights into how much cash flow is a company earning that could be used to service and pay back their debts. So it's exactly what it sounds like, times interest earned. If you look at the income statement, you're going to look at earnings before interest. And you might also look at EBITDA, which is earnings before interest, taxes, and depreciation, and divide that by your interest expense for the given year. So if you're earning, say your interest expense in round numbers is $100, and you're earning $200, well then your times interest earned is 2. The higher that number, the more comfortable the bank is going to be, or the more comfortable the lenders are going to be with that credit outstanding. So if your times interest earned is 10 or 20 or 30 or 50, you're in great shape. Nobody's probably giving you a lot of grief about how much debt you have outstanding, because whatever you did with that debt is producing the cash flow that was intended in the first place. Your bankers are probably clamoring to lend you more money if that's the case, but you don't need it because you're making all this money. So anybody that doesn't need a loan can get one. We've all been in that situation before. Okay, now let's go through each of those slides one by one, and we'll look at times interest earned first. We're going to take earnings before interest and tax, divide by interest expense. And if we look at Home Depot, that breaks down as these are probably in millions. So that's 15 billion in EBIT divided by 1 billion in interest expense. And you can see there times interest earned number at 14.5. A little bit better than it was in 2018. Take that back 5 or 6 years to see how it's trended, compares to its competition. You can see how stretched their balance sheet might be. That's a fairly easy one. How might we need to reformulate those numbers? You can see here that Moody's, I think this is Moody's, yes, Moody's adjusts these numbers for defined benefit pension plan expense, which we will cover in Module 9. Multi-employer pension plans, also 9. Operating leases, I think that's next week. I think we cover that in Module 5. Could be Module 6. So I'm not going to go into these tonight other than just to point out that as you're going through the entire semester, anytime we get into the accounting and you have some variability, you might need to go back to the financials and make some manual adjustments, which we call pro forma, so that you can present the numbers in a manner that allows you to compare them not just across time, but across your industry group. EBITDA coverage ratio, very similar. We're just looking up a little bit further on the balance sheet. So here, income statement, excuse me. So here's EBIT. That's what we used in our interest coverage ratio. To EBIT, we're going to add depreciation and amortization, which gives us EBITDA divided by interest expense outstanding. And you can see that the ratio becomes 16.5. Here's a nice little chart that if you can't find the chart, you can definitely find the data through Morningstar or Reuters that will show you how these ratios have trended over time. And you can see here that Home Depot's coverage ratios have generally been trending in the right direction. So they've been doing something right. The market's been expanding. More people are building homes. More people are refurbishing their homes. And the general picture of their business is becoming a little healthier. So all good things, and it really helps to put it in a graph like that because you can make sense of the direction a company's going in. Two others that are not complex, but we'll just touch on real quick, are cash from operations to total debt, exactly what it sounds like, and then free operating cash flow to total debt. The primary difference between the two is the inclusion or exclusion of capital expenditures. Capital expenditures normally are discretionary in nature. So these are, let me see here. I'll go back to the example of a house again. Last year, I replaced the fence in my backyard. So if I were a business and I needed to replace a fence, that would be a capital expenditure. And when I say that capital expenditures are discretionary in nature, well, in the long run, things need to be replaced because they break down. So in the long run, they're not discretionary at all. But in the short run, in any given 12-month period, you can usually delay maintenance CapEx. Unless something just breaks out outright. That's usually something that you can delay, which gives you those funds to service any debt outstanding in the short run. But in the long run, it's probably less discretionary than I might make it out to be. Home Depot's graph again, I won't belabor that point. Okay. Current ratio. Now we're moving into liquidity ratios. Liquidity means cash, or something that can be turned into cash relatively quickly. So what we want to know is if a company really needed cash for whatever reason, and there's all kinds of reasons a company might need cash. Maybe they actually do have some debt coming due, which you will need to know as the analyst looking at this business. And that's easy to find out. All you have to do is look at the 10K and the SEC filing. You go back, you look at the debt outstanding, and it'll be right there, printed in the report. It's going to tell you when this debt comes due. So if they have $1 million issue coming due, and the liquidity ratio doesn't tell you that they have $1 million on hand to cover that, well, you're illiquid. That's a bad thing. Maybe they don't have enough cash and marketable securities on hand to cover payroll. That's an even worse thing. This is something that you might have an interest in looking at for the company that you're employed by. If you work for a publicly traded company, go find out what their current ratio is. Current assets divided by current liabilities. So what you want is for current assets to be more than current liabilities. If so, that ratio is going to be greater than 1. Well, if you work for a company, I'd like it to be 2 or 3 or 10. That gives me a much higher degree of confidence that I'm actually going to get paid the next time they owe me a check. If it's less than 1, well, ask them why and make sure they have a good plan for fixing the situation. Otherwise, come next payday, there might be some chance you don't get paid, and that's a problem. So rather you find that out sooner than later, and maybe you can cash a paycheck and move on down to a more secure job for somebody else in the industry. Now look at the difference between current ratio and quick ratio. The denominator is identical, current liabilities. What's the difference inside of the numerator? What's the difference between current assets and cash? Well, that's a current asset. Marketable securities, that's a current asset. Accounts receivable, That's a current asset. So what's the difference? What current assets does the quick ratio exclude? What current assets is not up here in this numerator? And the answer to that question primarily is going to be inventory. Inventory is a current asset that we exclude when we're looking at the quick ratio, because that's a more conservative estimate of what we could actually turn into cash quickly. Inventory is not always super liquid. Usually we can move it in the next 6 months, depending on what our business is, but some of that inventory might be obsolete. You know, if it's the fashion industry, you know, you don't want to be sitting on some fashion item that nobody's buying anymore. I don't know what that would be because I'm not a fashion guy, but there's surely something that's out of style that nobody's buying anymore. Anyway, you get the gist of that. Okay, now let's move from liquidity ratios to solvency ratios. The difference primarily being that while liquidity refers to those assets that you can turn into cash, solvency looks at a company's total debt and compares it to its total equity to kind of get at or define or quantify a company's ability to meet its total debt obligations. So to define that or get at that, we're going to look at two primary ratios. The first one is liabilities to equity. So that's just, liabilities is debt. This is a debt to equity ratio. And then we have a total debt to equity ratio down here. So total liabilities would include the trade credit. And I commented on that at the top of the hour. I was talking about companies who's utilize trade credit, but oftentimes we'll exclude that from our analysis because it's non-interest bearing. Well, in a total liabilities to equity ratio, that would be included. In a total debt to equity ratio, which is really the more common, that would be excluded. And what you actually do end up counting is only the current portion of long-term debt, actually current and long-term portion, and short-term debt. Those are the only two items that comprise the numerator when we're looking at those two ratios. Again, always helpful to look at these things through a graphical lens. And this one's not a time series chart, but it's an industry chart. So one particular industry would show how you stack up against your competitors. Across all industries, you can tease out certain trends that are unique to the nature and operating structure of different businesses. So we're looking at solvency analysis here, which is your debt to equity ratios or liability to equity ratios. And you can see that the home improvement industry operates with, I guess, higher liabilities to equity ratios. So companies like Home Depot require a lot of debt to get going. They borrow a lot. Hotels and motels have a lot of debt outstanding relative to the amount of equity that they have outstanding. Automotive manufacturing, airlines, utilities, then you get down to professional services, retailing, minery manufacturing, restaurants, computer hardware, oil and gas, and publishing. So, why might that be? Well, one of the reasons why you might be able to borrow a lot at this end of the table down here would be that you have good assets to borrow against. If you have good assets that serve as collateral and a high degree of certainty with regard to your cash flows, if the bankers can count on your cash flows, they're going to be more willing to loan you a lot of money. Down here at the other end of the table, take oil and natural gas. Well, that's a speculative business. So bankers are going to be less willing to loan you a lot of money because they take on a lot of risk when they do it. Publishing, an asset-light business. So anyway, there's some insights into kind of what drives some of those fundamental differences. You know, again, look at these ratios on a graph. You can kind of draw some trends and understand how things are trending over time. That gives you insights into the company's business model. I don't need to belabor that point. Okay, learning objective number 4, describe the credit rating process and explain why companies are interested in their credit ratings. So the credit rating process is, well, here, I'll just move on to the kind of the next slide and show the ratings that we're looking at here are in these columns. We have 3 large credit rating agencies, and they all have their own process, but basically they're employing staffs of analysts to do credit research, everything that we've been talking about in the last hour here. And as a credit analyst moves through that process, they're going to rank order a company's, well, not just the company's likelihood of default, but then also an individual issuance of debt. They're going to rank order their likelihood of getting paid back based on where they stand in the capital structure. And using those 2 criteria, that debt issuance is going to receive a rating. And it's going to receive a rating that's in alignment with this table that you're looking at right here. And you can see that this line here is the line between non-investment grade speculative debt and investment grade above it. And that's a big deal. That line right there is a big deal, because if you go below it, your interest rate is going to spike, because that's where investors feel like anything lower than investment grade is a big change in risk. And if you're going to take on a significant amount of greater risk, you're going to need a significant amount of greater return. Now, that's true to a certain extent, but there's a big market dynamic that also drives that. Historically, we've looked at that line as being something significant. And maybe it's something significant, maybe it's not. But a whole bunch of people have gotten together and decided that it is. So when that happens, you see mutual funds establish themselves with a charter that says, we are an investment grade mutual fund, and therefore we're going to go out and we're going to buy investment grade debt. So if a company falls from investment grade to non-investment grade, well, they don't have a choice. They have to sell that debt. And that creates some very unusual trading dynamics around that investment grade, non-investment grade distinction. So if you fall from investment grade to non-investment grade, what you typically see by the market is a whole bunch of non-economic forced selling pressure. And that can create opportunity for savvy investors who have the luxury of patience to come in and say, well, I know how this works. There's a whole bunch of institutional investors that can't hold that debt anymore. It just got downgraded 1 notch. It's the company's not fundamentally that much different, but all these investors sold, which drove the price down even further than maybe it should have. And now it actually looks pretty good. And I'd love to pick that up, yielding 8, 9, 10%, because I'm confident that the company's fortunes are better than what the market typically indicates. Now, I'm telling a story, right? Could be that this is the biggest dog that there ever was, and the rating agency should have downgraded it a long time ago. And if you buy now, you're going to be catching a falling knife, and it's likely to go from BA1 to BA2 to BA3 all the way down to CA3 and ultimately bankrupt. And that happens too. Notwithstanding, this line between investment grade and non-investment grade, it does drive some forced selling, and it does drive some non-economic trading. And it is something that we have to be aware of when we're looking at debt outstanding in the marketplace. And if we all put our CFO hats on, now imagine you're the CFO of the company that you're doing research on this semester. If your debt starts to approach that junk status, that non-investment grade status, well, you should be raising the alarm bells internally, because your cost of debt is about to go way up. And the way the Wall Street community looks at you, thinks about you, writes about you, reports on you is about to change, because, well, you're about to move into a category that used to be called junk. And nobody wants to be in a category that used to be called junk. And that changes the dynamics that investors use to frame your story and loan you money and understand your prospects. And it's a big deal. Okay, this is the process Moody's goes through. This is a new slide that our authors gave us. This version of the text, I wasn't that impressed with it. This is a meaningful slide here. You can see just how impactful that drop is from BBB minus, which is investment grade, to non-investment grade on the right-hand side of that line. You know, this looks like a pretty normal histogram, which is a distribution chart, until you get to that line, and then you see a huge drop in that distribution. And the reason for that is that every CFO in the country who's right here or close to it is fighting as hard as they can fight to keep their company from falling off that cliff into junk status or non-investment grade status. So be mindful of where your company falls on that spectrum. And one of the ways that you can be mindful of that is by looking at ratio. Do the ratio analysis for your company and know that the investment grade line is right here. So you can see where investment grade companies typically fall on all of these different ratios. You know, if you're investment grade, what's that mean for your CapEx to depreciation ratio? What's that mean for your EBITDA to average asset ratio? What's that mean for your margin? Now, you know, maybe you can be on one side of the line or another side of the line for one of these. But if you got 8 of 10 underneath this line and you're not yet junk status, you probably will be shortly. And if you figure that out for your company, that's a huge sell signal, because it means that you just gained some insight ahead of what's likely to happen in the future. And this is one of the big ways that you can differentiate yourself, that you can distinguish yourself as an analyst. Okay. One quick slide on something called the Credit Rating Agency Reform Act. This was signed into law in 2006 after accounting scandals like Enron and WorldCom and others. The regulators got together and they designated a very short list of what they now call nationally recognized statistical ratings organizations, so NRSROs. And there's only a handful of them, and these are the companies that have been deemed able to rate public debt outstanding. And we just went through 4 of them, and that's really all there is to it. But it means that these companies have a lot of power, and we just need to recognize that they are one of a very small number that have been authorized to do that. Okay, I want to move on to learning objective number 5, and we're going to look at something called a bankruptcy prediction score or bankruptcy prediction indicator. This particular indicator is called the Altman-Z score or Altman-Z model, created by Professor Altman. Can't remember Professor Altman's first name or where he went to school, but this has been around for a very long time, and it's persisted because it has a statistical significance to it. If you're worried that your company might be falling below some of those thresholds that would indicate junk status, or maybe even a notch or 2 below that, and that your company might be on a path or trajectory that leads to bankruptcy, well, you might be interested in this Altman-Z score. So what Professor Altman found out was by looking at these 5 metrics and backtesting them in a way that was done with a multiple regression, he could calculate the payoffs or the factors associated with each one of these that ultimately led to a score which was indicative of bankruptcy. So I want you all to find out what the Z-score is for the companies that you're doing work on this semester. And, you know, do it yourself would be awesome. That's a terrific exercise to go through. But there's also a whole bunch of websites that'll just give it to you without you having to do it yourself. But doesn't matter. You're going to have to find out what each of these ratios are independently of the Altman Z-score, so you might as well do it. And once you have those ratios, you just multiply each by its factor and add them together. So you can see here that based on these factors, well, the largest weighting to any factor is this EBIT to total assets. So that has a lot of indication over whether or not a company might be going bankrupt in the future. Now, once you have done all those calculations and added them up, this is how you determine whether or not the score is meaningful. Well, not whether it's meaningful, but whether or not your company might be at risk of bankruptcy. So if your score is greater than 3, the company is healthy. If it's between 1.8 and 3, that's the gray area. And if it's less than 1.8, your company's in financial distress. And if it's a lot less than 1.8, get the heck out of there, because they're about to fall on hard times. Okay, and here's an example of how to compute an Altman Z-score, but it's not terribly difficult, so I'm not going to go through that example in class. And that, my friends, is Module 4. So I'm very hopeful that a lot of what we talked about tonight was review. I don't consider that module to be, terribly in-depth. There is a little bit of terminology to it, so if there's anything I can clear up, I'm happy to do so. But that was my lecture for tonight. So I'm going to pause there and take questions before we call it a night.
I have a question, but it's more so about my own personal project. I got the Northern Trust.
Oh yeah, that's fine. And anything.
All right. Do you think it would benefit me to go ahead and change it up, because the financials of it are very different than everything that I'm reading in the books?
Yeah, James, I'd advise you to do so, and unless you've done a lot of work on the company already, or have some tie to the company or an interest in the company, just set it aside and start again. I mean, we're not so far down that road that you're going to have a big sunken cost in it just yet.
Yeah, I've only done like the ratio analysis, so yeah, that's fine.
Okay, totally your call, but yeah, it can get a little hairy if you're looking at a company with different key performance indicators and different financials. So your call.
Okay, thank you.
Yep. Try to train myself to sit through these awkward silences, because I know there's a few of you out there that probably got a question, but you're just slow to push the button and ask ask what you need to ask.
Fiona asked, what's the research report milestone covering modules 1 through 4 due on the 28th? That's in the group.
Oh, yeah, thank you. Okay, yes. What's the research report milestone covering modules 1 through 4 due on the 28th? I don't know, Fiona. Where'd you get that from?
It's on the syllabus.
Is it really? I remember doing that at one point in time. Man, good. You read the syllabus. Good for you. Okay, though, I can't believe that's still on there. Man, I feel like the absent-minded professor tonight. Okay, well, here's the deal. If you look at the sample research reports on the site, and you go to the back of them, they're organized as an executive summary and an appendix. And in that appendix, you're going to see that they are organized by module, and you have modules 1 through 15. Well, at this point in the semester, I have advised that you should, kind of sort of be compiling these modules as we go. So last week there was some ratio analysis. James said he did that, so great. Well, if you've done that, you've kind of done the beginnings of the work that you'll need for the appendix of that assignment. So you asked the question, what's the milestone? Well, the milestone would be the appendices for modules 1, 2, 3, 4. So module 1, you're doing a little work on SWOT analysis, Porter's 5 forces. Module 3, you're doing ratio analysis. Module 4 tonight, you're doing some credit analysis. And if you want to turn that in and get feedback for it, great. Nothing's due. Nothing's due on the 28th. That's a mistake. I need to take that out of the syllabus. So thank you for asking the question. The fact that it's still in there is a mistake on my part. Most students in this course approach that research project by compiling information through about the first half of the course, and then they begin to put that research project together about the second half of the course, and then around about week 11, if you're thinking ahead a little bit, you can turn the whole thing into me for review, and I'll give you some feedback and tell you exactly what you need to do if you want to get an A on that report. But good question. Thank you for asking it. Okay, Alex has got one here. Why would anyone choose to invest in a non-investment grade security? It's because the money talks is the answer to that question. The non-investment grade means riskier, and riskier means more money. I forget what so if you buy an investment grade credit right now, I used the example of Coca-Cola earlier in the class. The Wall Street Journal reported that they had refinanced all their debt. They were paying 3%, and now they're paying, I think, about 1%. Well, that's a big yawn. I mean, it's Coca-Cola, right? So you're almost certain to get paid back, but you're only going to get paid back 1%. So contrast that to another company that might be high yield, but it's going to pay you 6 or 7, and now you're thinking, okay, well, Coca-Cola is safe, but I make almost nothing. This other company's over here is a little bit riskier, maybe a lot riskier, but I got a chance to make some real money. And when I don't know if you've taken the investments class yet, but used to be Dr. Mock that taught that. I've taught it before. Dr. Clark teaches it. I don't know who's teaching it now. Anyway, when you get into that class, you'll start talking about the benefits of adding all these different types of investments to a portfolio. They have diversification benefits. So most professional investors will buy both. They'll buy the safe Coca-Cola and they'll buy a little high yield. They'll mix them together, and at the margin, you'll get a higher rate of return with safer total risk, a less total risk, and it works out pretty well. But that's a great question. Thanks for asking it.
Last question for me.
Yes, sir.
As far as quarterly reports versus annual reports. What is your suggestion?
Start with the annual, because that's where you're going to get all of the best information. There's a lot of stuff that goes into an annual that's not required to be disclosed in a quarterly. So say you're working on, whatever company, Home Depot, and Home Depot's latest annual was probably as of last April. Go there first, start there. You'll get all of the disclosures that are required in an annual report that you don't get in a quarterly. And after you've digested that one, then go to the most recent quarterly, because you're going to get an update about, well, whatever they have going on in the last month or the last quarter, and that's going to be meaningful for what their business is doing. So that's a good example. So if you're, most of the companies that we're looking at in this class, if they filed their annual report last March, they didn't have a clue what COVID was really going to do to their business models. So if you read the annual report, you're going to get a great overview of the business, and you're going to understand the accounting and all the assumptions that go into that, and the management team, and you get a good strategic overview of the business. So that, Porter's five forces and SWOT analysis and all that good stuff will come out of the annual report, but you don't get anything on COVID. So then you're going to have to go to the most recent quarterly to understand what something like COVID is doing to their business. So you really use the two in tandem.
Okay, that makes sense.
That kind of leads into my question. So I have Wynn Resorts, and it's extremely affected by COVID, particularly in the last 9 months. So I think I'm going to have to make some bold assumptions about possibly when this would end, and or when they're going to get back to a threshold that they were at previously. So should I just go along those lines with, the previous 5 years have been, pretty normalized in that industry, right? Across the board, they're probably a low rate growth industry always, with a high debt is what it kind of looks like. So it's just a weird time, but also why I picked it, because I think it's an interesting topic to look at right now. So without giving me the answer, I just wondered what you would have to say about that. You just mentioned looking at those last quarters, which I've done, but
I wish I had the answer to give. You're right. You just laid it out there perfectly. You can't use the last 3, 4, 5 years to forecast the future, because they're non-comparable. So we're in a new environment, and I don't hold you accountable for knowing what's going to happen in the future as it pertains to COVID. But I think it's a safe bet to say that their sales next year will be lower than they were last year as people accommodate this. So you need to kind of justify that a little bit. And I would encourage you to lean very heavily on the Wall Street analyst community, because those Wall Street analysts that write those reports, well, they have access to some of the best think tanks in the country. So they're out there, interfacing somebody on their team, probably not the analyst that covers Wynn Resorts, but if you're looking at a report that was by JP Morgan, they have the largest research staff in the world, or one of them, and they have people who are in touch with scientists at the CDC, and they have a whole team that covers biopharma. So they have insights into how quickly that vaccine is going to come and how quickly it's going to get rolled out. And they have other analysts whose job it is to cover the political environment, and they synthesize all this. So they're gonna be able to make a case for how quickly somebody like Wynn Resorts is going to get back to what you might think of as trend line. So analyze that. Make your own self-assessment about what points you agree with and what points you disagree with, and then use that to come up with your own forecast, and then have that be the benchmark or the guiding light for your report. But Thomson one will add a lot of workable information to your project.
Thanks, appreciate it.
Yep. All right, gang. Well, I'm gonna call it tonight. I'll get homework 4 and test 4 posted here in the next couple days. Shoot out a a heads up on Canvas, and we'll go from there. So thanks, everybody. Have a good night.
You too.
Thank you.